Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is this Starbucks Challenger a good investment? In this video we will be analyzing if Dutch Bros stock is a buy. Could Dutch Bros, stock ticker symbol BROS, be ready to go even higher? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Dutch Brothers. Dutch Bros was founded in 1992 when brothers Dane and Travis, inspired by their family's dairy farm, opened the first Dutch Bros stand in Grants Pass, Oregon. Starting as a simple push cart, Dutch Bros quickly gained popularity for its unique coffee blends and friendly service. Their commitments to creating a strong community and offering high-quality beverages fueled their growth. Dutch Bros offers a wide variety of coffee, tea, and energy drinks, along with food options like pastries and granola bars. Today, Dutch Bros is a publicly traded company with thousands of locations across the western United States and expanding into new markets. Their headquarters are located in Grants Pass, Oregon. Now let's look at the price action. Starting with the 1-year chart, we see that Dutch Bros had a CAGR of about 36%. Zooming out to the 5-year chart, we see that Dutch Bros had a CAGR of 2% over the past 3 years. Dutch Bros has been a very strong grower recently. If we perform a backtest comparison of investing $10,000 in Dutch Bros versus the S&P 500, we find some poor results for Dutch Brothers in that comparison. A $10,000 investment in Dutch Bros would have shrunk to $8,132, whereas the same amount invested in the S&P 500 would have grown to $11,898. This translates to an annualized return of -7.94% for Dutch Bros compared to 7.20% for the S&P 500. Dutch Bros was also significantly more volatile, with a standard deviation of 53.35% compared to 18.66% for the S&P 500. When looking at year-over-year performance, Dutch Bros outperformed the S&P 500. In the best year, Dutch Bros grew 30.72% while the S&P 500 grew 26.19%. In the worst year, Dutch Bros fell 44.63% while the S&P 500 fell 18.17%. Finally, Dutch Bros also significantly underperformed the S&P 500 in terms of both the Sharpe ratio and the Sortino ratio. Overall, Dutch Bros has trailed the S&P 500 by nearly every metric over a long time horizon. Now let's hop over to market share and take a look at Dutch Bros market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Dutch Bros is categorized as a fast food restaurant company. Expanding the fast food tab, we can see that Dutch Bros has the 4th smallest market share of the companies listed, but it does appear to be gaining market share. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Dutch Bros, BROS, and see that the market share is 0.12% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Dutch Bros attracts very little food spend but has been growing market share very rapidly. The 5-year market share CAGR for Dutch Bros is 31.18%. This means that Dutch Bros market share doubles roughly every 2.5 years. If we start in 2020, we see that the market share was 0.05%, 0.07% in 2021, 0.09% in 2022, 0.11% in 2023, and to 0.12% over the trailing 12 months. Love the strong market share gain year after year. Let's take a look at the fundamentals. Gross margin is 27%. This is on par with newer restaurant companies. Revenue has compounded at around 43% over the past 5 years and has reached over $1.04 billion most recently. Dutch Bros revenue had been growing very nicely and has finally crossed the $1 billion mark. Congratulations. When we look at cash flow, we see a 48% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 73% CAGR. As a result, free cash flow has flipped negative. Dutch Bros looks pretty decent here. While the growing operating cash flow is good news, management is betting on expansion, spending ever increasing amounts on capex. I like the growth but see some signs of caution. Weighted average shares outstanding have risen substantially over the last 5 years, going from 5 million shares in 2020 to 68.8 million shares most recently. Dutch Bros has been diluting shareholders. It should be clearly noted that even after going public in 2021, Dutch Bros has continued to dilute shareholders at a rate of about 20% per year. EWW. Now let's view return on invested capital. Return on invested capital has grown from -26.3% in 2021 to 3.6% most recently. While this value is not that great, it is definitely moving in the right direction. I like where this is going. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 8 days in 2020 to 10 days most recently, Dutch Bros has gotten a little less efficient over time. However, the most recent trend is downwards, so this is a good sign. Last, let's look at Dutch Bros debt. The net debt to EBITDA has actually increased over time, going from 2.4 in 2020 to 3.9 most recently. This is a small increase and the value has actually been coming down since 2022. Dutch Bros looks kind of sweet. In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the food fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Dutch Brothers. It is a restaurant company with a gross margin of 27%. The 5-year revenue per share CAGR is -36% and the 5-year free cash flow per share CAGR is around -6%. While the gross margin is okay, per share metrics for revenue and free cash flow are negative because of the aggressive shareholder dilution. A return on invested capital of 4% is low but improving. Next, the cash conversion cycle of 10 days is acceptable and looks to be improving recently. Concerning debt, a net debt to EBITDA of 4 means that it takes Dutch Bros about 4 years of earnings to pay off its debt. So from a fundamental standpoint, Dutch Bros gains some efficiency points but loses some growth points. Now let's switch our attention over to valuation. Dutch Bros is massively overvalued relative to the S&P 500 with a ratio of 6.8. The price to earnings growth, or PEG ratio, is 7.5, indicating that Dutch Bros is overvalued relative to their projected earnings growth. Dutch Bros is an impressive upstart coffee company that is taking on Starbucks. They have a passionate fan base and a strong brand, but financials still matter. First off, the company's return on invested capital has been on the rise. That's a good sign, meaning they're getting better at turning their money into profits. But here's the kicker, it's still relatively low compared to industry leaders. So, while it's improving, there's room for growth. On the flip side, revenue per share and free cash flow per share have been dipping. This means they're making less money per share and generating less cash per share. As I mentioned earlier, these results are due to massive shareholder dilution. In 2023, Dutch Bros sold $300 million in stock at around $25 per share, using those funds to pay down debt. Given that the total debt is now 33% larger and the share price has breached $40 per share, I would not be surprised if management decides to dilute shareholders again. So, what does this all mean? Well, Dutch Bros has potential. The improving return on invested capital is a positive sign, but the declining revenue and free cash flow per share are red flags. If you're a long-term investor, you might be willing to wait for the company to turn things around. But if you're looking for quick returns, there may be better options out there. Still, I like the rapid market share growth and its popularity among coffee drinkers. I will keep my eye on this. For me, Dutch Bros is going on the watch list. Many thanks for watching. What do you think about Dutch Bros and their massive shareholder dilution? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.